Hey Vision Pro family! It's Abby here, ready to dive into the exciting world of finance with you all. Today we're tackling a question that's on many people's minds: investing versus trading. Whether you're just starting out or have some experience under your belt, this video is for you. We'll break down these two approaches to the stock market, exploring their differences, advantages, and disadvantages. We'll use clear examples to make everything crystal clear because here at Vision Pro, we believe knowledge is power. Empowering you to make informed financial decisions is our top priority. So grab your notebooks, settle in, and let's get started on this journey to financial literacy together. Remember, understanding your options is the first step toward building a brighter financial future. By the end of this video, you'll have a solid grasp of investing and trading, giving you the confidence to make the right choices for your unique financial journey. Today's battle of the financial titans: investing versus trading. In one corner, we have investing, known for its long-term strategy and potential for steady growth. Think of it as planting a seed and patiently nurturing it into a mighty tree. In the other corner, we have trading, a more dynamic approach focused on short-term market moves and capitalizing on quick opportunities. Imagine yourself as a surfer, riding the waves of market fluctuations for potential profits. Both investing and trading offer unique paths to building wealth in the stock market. They each come with their own set of rules, risks, and potential rewards. Our goal today is to equip you with the knowledge to determine which strategy aligns best with your financial goals, risk tolerance, and personality. Why are we dedicating an entire video to this topic? Because understanding the difference between investing and trading is crucial for anyone looking to grow their wealth in the stock market. This isn't just about picking stocks. It's about crafting a financial strategy that aligns with your goals and aspirations. Are you dreaming of early retirement, saving for your dream home, building a safety net for the future? Your approach to the stock market plays a significant role in achieving these milestones. By grasping the core principles of investing and trading, you're taking control of your financial destiny and setting yourself up for long-term success. This knowledge empowers you to make informed decisions, avoid common pitfalls, and maximize your earning potential. It's time to ditch the confusion and embrace clarity. Let's equip you with the tools and insights needed to navigate the stock market with confidence and make your financial dreams a reality. Let's take a moment to explain the concept of a breakup in the context of investing. In simple terms, a breakup refers to the separation of a company into smaller entities. This can often lead to significant changes in stock prices. It's a strategic move aimed at unlocking value for shareholders. By breaking up, a company can focus on its core strengths and improve efficiency. This can result in better performance and increased shareholder value. However, like investing, understanding a breakup requires a long-term perspective. It requires patience, discipline, and a forward-thinking mindset. It's about navigating the market's inevitable ups and downs, knowing that strategic breakups can lead to long-term gains. It's a strategy that can reward those who understand the potential for slow and steady growth through strategic restructuring. Let's bring this concept to life with an example you can easily visualize. Imagine you purchased 10 shares of Apple back in 2019, when the stock was trading around $50 per share. That would have cost you a cool $500. Fast forward to today, 2024. Apple's stock price has soared to over $180 per share. Your initial investment of $500 has now ballooned to a whopping $1,800. That's a profit of $1,300 simply by holding on to those Apple shares and letting them ride the wave of the company's success. This example perfectly illustrates the power of long-term investing. By choosing a solid company with a track record of growth and innovation, your investment has the potential to generate impressive returns over time. Of course, past performance is not indicative of future results, but it highlights the potential rewards of a well-executed investing strategy. Now, let's delve into the specific advantages that make investing an attractive option. One of the most compelling pros is the potential for long-term growth. Another perk is the power of compounding. Investing also offers passive income through dividends. Finally, long-term investments often enjoy more favorable tax treatment. While investing offers a path to wealth creation, it's essential to acknowledge the potential downsides. One main drawback is the time commitment required to see returns. Another risk is market volatility. The stock market is prone to fluctuations. Your investments could lose value in the short term. A long-term perspective and sound strategy are paramount. Investing requires research and due diligence. Selecting the right companies involves analyzing financial statements and industry trends. Finally, not all companies pay dividends. Some reinvest profits for growth, while others may not generate sufficient profits to distribute dividends. Now let's shift gears from the patient world of investing to the fast-paced arena of trading. If investing is like nurturing a tree, trading is more like riding a wave. It's about capitalizing on short-term price fluctuations in the stock market to make a profit. Traders buy and sell stocks within shorter time frames, ranging from minutes to days, sometimes even seconds. Their goal is to buy low and sell high, profiting from the difference. It's a more active approach that requires constant monitoring of the market, analyzing trends, and making quick decisions. Trading is not for the faint of heart. It demands a deep understanding of technical analysis, risk management, and market psychology. Successful traders are agile, adaptable, and possess a high tolerance for risk. They thrive on the excitement of the market's ebb and flow, always seeking opportunities to capitalize on price movements. Let's illustrate trading with an example that showcases its potential for quick profits. Imagine you purchased 100 shares of Tesla at $800 per share for a total investment of $80,000. You've been closely following market news and believe Tesla's stock is poised for a short-term surge. Just as you predicted, positive news about Tesla's latest electric car model hits the market, and the stock price jumps to $850 per share within a few days. You decide to sell your 100 shares, cashing in a cool $85,000. That's a tidy $5,000 profit in a matter of days. This example highlights the potential of trading to generate quick returns by capitalizing on short-term market movements. However, it's crucial to remember that trading involves significant risk. Prices can fluctuate rapidly, and losses can accrue just as quickly as profits. Trading offers several advantages for those who thrive in a fast-paced environment. One of the most alluring aspects is the potential for quick profits. Successful trades can yield substantial returns in a short amount of time. Traders can enter and exit trades quickly, adapting to market conditions. This agility allows potential profit from both bull and bear markets. Finally, trading offers an element of excitement and adrenaline rush. High risk, high reward. Cons of trading. While trading can be lucrative, it's essential to acknowledge the significant risks involved. The most prominent drawback is the potential for substantial losses. Markets are inherently unpredictable, and even experienced traders can make losing trades. Another risk is the emotional toll trading can take. The constant pressure to make profitable trades, the fear of missing out on opportunities, and the stress of potential losses can be emotionally draining. It requires a high level of discipline and emotional control to navigate the psychological challenges of trading. Trading also demands significant time and effort. Successful traders dedicate countless hours to researching markets, analyzing charts, and monitoring their positions. It's not a passive investment strategy and requires a considerable time commitment. Finally, short-term trading profits are often subject to higher taxes compared to long-term investments. In many jurisdictions, profits from trades held for less than a year are taxed as ordinary income, which can significantly impact your net returns. All right, Vision Pro family, let's break down the key differences between investing and trading, starting with the time horizon. This is all about how long you plan to hold on to your stocks. Think of it as the time and market factor. Investing is a long game, like planting a tree and patiently waiting for it to grow. We're talking years, even decades, of letting your money compound and your investments mature. It requires patience and a belief in the long-term growth potential of the companies you choose. Trading, on the other hand, is all about speed and agility. It's like catching a wave at its peak and riding it for as long as it lasts. Traders aim to profit from short-term price fluctuations, holding onto stocks for days, weeks, or even minutes. So ask yourself, are you comfortable playing the long game and letting your investments grow over time? Or do you thrive in a fast-paced environment and enjoy making quick decisions to capitalize on short-term opportunities? Next up, let's talk about risk tolerance, a crucial factor to consider when choosing between investing and trading. How comfortable are you with the ups and downs of the stock market? How much potential loss are you willing to stomach? Investing, while not without risk, is generally considered a more conservative approach. Long-term investors ride out market fluctuations, knowing that over time, quality companies tend to weather the storms and emerge stronger. Trading, however, embraces volatility. It thrives on the market's ups and downs, as these price swings create opportunities for profit. However, this also means traders must be prepared for the possibility of significant losses, especially in volatile market conditions. So ask yourself, do you prefer a more hands-off approach and a smoother ride, even if it means potentially lower returns? Or do you enjoy the thrill of the chase and are comfortable with higher risk for the potential of higher rewards? Section 3. Effort and involvement, passive growth versus active management. Now let's consider the level of effort and involvement required for each strategy. How much time and energy are you willing to dedicate to managing your investments? Are you a hands-on or a hands-off kind of investor? Investing, particularly long-term investing, can be relatively passive. Once you've done your research and built a diversified portfolio, you can essentially set it and forget it, checking in periodically to rebalance or make adjustments as needed. Trading, however, demands constant attention and active management. Traders need to stay informed about market news, analyze charts, monitor their positions, and be ready to make quick decisions based on changing market conditions. So ask yourself, do you prefer a more hands-off approach, letting your investments grow steadily in the background? Or do you enjoy being actively involved in the market, researching, analyzing, and making trades on a regular basis? Section 4. Potential returns, slow and steady versus quick wins and losses. Now let's address the elephant in the room, potential returns. Both investing and trading offer the potential for profit, but the timeline and magnitude of returns differ significantly. Investing is like watching a tree grow. It takes time. Trading, on the other hand, is like trying to catch lightning in a bottle. It offers the potential for quick and substantial profits, but it also carries a higher risk of losses. Section 5. Tax implications, long-term benefits versus short-term bites. Now let's talk taxes, because nobody likes giving away more of their hard-earned money than they have to. The tax implications of investing and trading can vary significantly depending on your jurisdiction and the duration of your holdings. In many countries, long-term capital gains, those from investments held for longer than a year, are taxed at a lower rate than short-term capital gains. This can make a big difference in your net returns, especially over time. Short-term trading profits, however, are often taxed at your ordinary income tax rate, which can be significantly higher. This is because the government views short-term trades as more speculative in nature. So, it's essential to factor in the potential tax consequences when deciding between investing and trading. Consult with a qualified tax advisor to understand the specific rules in your jurisdiction and how they apply to your individual circumstances. Beyond the numbers, it's crucial to consider the psychological impact of each strategy. Investing and trading can take a toll on your mental well-being, especially during periods of market volatility. Investing, with its long-term perspective and focus on steady growth, can be a more emotionally stable approach. It requires patience and the ability to ride out market fluctuations without making rash decisions based on fear or greed. Trading, on the other hand, can be an emotional roller coaster. The constant pressure to make profitable trades, the fear of missing out on opportunities, and the stress of potential losses can be mentally draining. It requires a high level of discipline and emotional control. So, be honest with yourself about your emotional resilience and your ability to handle stress. Choose a strategy that aligns with your personality and your capacity to navigate the psychological ups and downs of the market. Both investing and trading require continuous learning and adaptation, but the pace and depth of learning differ significantly. How much time and effort are you willing to invest in expanding your knowledge and refining your skills? Investing, while not a walk in the park, typically involves a more gradual learning curve. You can start by investing in index funds or ETFs, gradually expanding your knowledge as you gain experience and confidence. Trading, however, demands a steeper learning curve and constant adaptation. Traders need to be up to date on market trends, news, and technical analysis techniques. It's a continuous process of learning, adapting, and refining your strategies to stay ahead of the game. So consider your learning style and your willingness to dedicate time and effort to mastering the intricacies of the market. Choose a strategy that matches your learning appetite and your commitment to continuous improvement. Last but not least, let's talk about the capital required to get started with each strategy. How much money do you need to invest or trade effectively? The answer, of course, varies depending on your goals and risk tolerance. The good news is you can start investing with a relatively small amount of money, especially if you're using fractional shares or investing in low-cost index funds or ETFs. This allows you to dip your toes into the market without breaking the bank. Trading, however, often requires a larger capital outlay to effectively manage risk and generate meaningful returns. This is because trading costs, such as commissions and fees, can eat into your profits, especially if you're making frequent trades. So assess your financial situation and determine how much capital you're comfortable allocating to investing or trading. Remember, it's crucial to invest or trade within your means and avoid risking money you cannot afford to lose. Now that we've explored the ins and outs of investing and trading, let's dive into which strategy might be the right fit for you. Imagine the investor profile as someone who embodies patience, discipline, and a long-term vision. They see the stock market as a marathon, not a sprint. They're not fazed by short-term market fluctuations because they understand that over time, quality companies tend to prevail. They're in it for the long haul, letting their investments compound and grow steadily over years, even decades. Investors prioritize minimizing risk and maximizing their chances of steady, consistent returns. They meticulously research companies, analyzing their financials, understanding their competitive advantages, and assessing their long-term growth potential. If you find yourself nodding along, resonating with these characteristics, then investing might be your jam. It's about playing the long game, trusting in the power of compounding, and letting your money work for you while you focus on other aspects of your life. Now let's paint a picture of the trader profile, someone who thrives on action, adaptability, and the thrill of the chase. They see the stock market as a dynamic playing field, full of opportunities to capitalize on short-term price movements. Traders are quick on their feet, able to analyze information rapidly, and make swift decisions based on changing market conditions. They're comfortable with higher risk, knowing that potential rewards often come with greater volatility. They're constantly learning, adapting their strategies, and refining their skills to stay ahead of the curve. They enjoy the challenge of navigating the market's ebb and flow, always seeking an edge to maximize their profits. If you're nodding your head vigorously, feeling the adrenaline rush just thinking about it, then trading might be your calling. It's about being an active participant in the market, capitalizing on opportunities as they arise, and thriving in a fast-paced, ever-changing environment. Choosing between investing and trading isn't just about personality. It's about aligning your financial strategy with your lifestyle, goals, and aspirations. Think of it as finding the perfect outfit for your financial journey. What are you saving for? A down payment on your dream home? Early retirement? Your children's education? Your financial goals will significantly influence your investment timeline and risk tolerance. Consider your current financial situation, your income, expenses, and any existing investments. Are you comfortable tying up a significant portion of your capital in long-term investments, or do you need more liquidity and flexibility? Finally, be honest about your time commitment. Do you have the bandwidth to actively manage trades, monitor the market, and stay updated on financial news? Or do you prefer a more passive approach, checking in on your investments periodically? Section 4. Risk tolerance. Finding your comfort zone in the market. Risk tolerance is like your personal spice level for financial decisions. Some people crave the heat of high-risk, high-reward investments, while others prefer a milder, more conservative approach. There's no right or wrong answer. It's about finding what sits well with you. Think about how you'd react to a sudden drop in the market. Would you panic and sell everything, locking in your losses? Or would you see it as a buying opportunity, confident that the market will eventually recover? Your risk tolerance is influenced by various factors, including your age, financial situation, investment goals, and even your personality. Younger investors with a longer time horizon might be more comfortable with risk, while older investors nearing retirement might prefer a more conservative approach. Remember, investing and trading always involves some level of risk. The key is to find a strategy that aligns with your risk appetite, allowing you to sleep soundly at night, knowing your investments are working towards your goals. Section 5. Time commitment. Balancing your portfolio with your schedule. Time is a precious commodity, and managing your investments requires a certain level of commitment. Before diving headfirst into investing or trading, assess how much time you're realistically willing and able to dedicate to your financial endeavors. Investing, particularly long-term investing, can be relatively hands-off. Once you've done your research, built a diversified portfolio, and established a rebalancing strategy, you can essentially let your investments do their thing. Trading, however, demands a more significant time commitment. Active traders need to monitor the market regularly, analyze charts, research companies, and stay informed about economic events that could impact their positions. Be honest with yourself about your available time and energy. If you're constantly juggling work, family, and other commitments, diving into the world of day trading might not be the best use of your precious time. Section 6. The best of both worlds, combining investing and trading. Who says you have to choose just one? Many investors find that a blended approach, combining elements of both investing and trading, works best for them. It's like having your cake and eating it too. You could allocate a larger portion of your capital to a diversified portfolio of long-term investments, providing a solid foundation for steady growth. Then, you could set aside a smaller portion for more active trading, allowing you to scratch that market itch and potentially capitalize on short-term opportunities. This hybrid approach allows you to benefit from the long-term growth potential of investing while enjoying the excitement and potential for quicker returns that trading offers. It's all about finding the right balance that aligns with your risk tolerance, time commitment, and financial goals. Section 7. Seeking guidance. Navigating the market with expert advice. Navigating the world of investing and trading can feel overwhelming, especially for beginners. Don't be afraid to seek guidance from experienced professionals who can provide personalized advice and help you make informed decisions. Financial advisors can help you create a comprehensive financial plan, assess your risk tolerance, recommend investment strategies, and answer any questions you may have along the way. Think of them as your financial co-pilots, helping you navigate the complexities of the market. Remember, not all financial advisors are created equal. Look for fiduciaries who are legally obligated to act in your best interest. Do your research, ask for referrals, and find an advisor you trust and feel comfortable working with. Section 8. The journey to financial success. Taking control of your future. Congratulations, Vision Pro family. You've reached the end of our deep dive into investing versus trading. You're now equipped to make informed financial decisions. Remember, the most important step is to take action. Start now and let time be your ally. The sooner you begin, the more your money can grow. Embrace the world of finance and build the future you deserve. Section 1, the power is in your hands. And there you have it, Vision Pro family. We've journeyed through investing and trading, exploring their nuances. Remember, there's no one-size-fits-all answer. It's about finding the approach that aligns with your goals. Whether it's long-term investing or active trading, knowledge is power. The more you learn, the better equipped you'll be. Keep exploring, keep learning, and never stop striving to expand your financial literacy. The journey to financial success is a marathon, not a sprint. There will be ups and downs, but with patience and discipline, you can navigate the market with confidence. So go out there, Vision Pro family, and make your financial dreams a reality.